Hello, I'm Beaulieu from ITR Economics. Thank you for joining us for the June 2nd, 2023 edition of FedWatch. And there's three things I'd like to cover today. And they arose from just reading articles like I always do about people think the Fed is going to raise, people think the Fed isn't going to raise. It looks like Wall Street, from reading the stock market, is thinking that they are going to lower the interest rate, and they may be disappointed. But three things stood out that I thought, well, if our folks were reading that, they'd be getting the wrong message. So those are the three things I want to talk about. One is that someone was proclaiming that GDP was still strong, and therefore rates are likely going to go up. And retail sales were incredibly strong, so interest rates are likely to go up. And the labor market trends are still strong, and therefore interest rates are likely to go up. And then, we have to be careful about analyst bias in our work. We think it'd be negative for the economy to have interest rates go up in the second half of 2023 in terms of seeing the recovery start on time in 2025. But I took each of those things apart and looked at them. For GDP in particular, and this is adjusted for inflation, I'm not sure what people are looking at when they say the data is strong, but growth has been slowing for 3 consecutive quarters. And the first quarter came in above the second quarter by 0.32%. And I don't normally bore you with numbers, but the low side normal is 0.29%. So this was just 4 basis points from being abnormally weak growth. Now, we use rate of change, so the 312 rate of change improved to 1.6%, but that's only because, and you may not remember this, we had a surprise decline in GDP in the first quarter of 2022 because of some government accounting things and pulling out of Afghanistan. So don't be beguiled by people telling you that GDP is strong. GDP is weakening. It's on track with our forecast. It's hard to imagine that we're going to be able to escape from underneath the shadow of the higher interest rates that the Fed has hoisted upon us. The second thing, as I mentioned, was retail sales were incredibly strong. And I don't know what that person is looking at, but April retail sales, and this is the advanced estimate, came in just 0.2% ahead of last April. That's not incredibly strong. And when we look at the month-to-month movement, April came in 2.4% below March. And that was weaker than normal behavior. That isn't strong. And the seasonal rising trend that normally begins in April with the 3-month moving total has started off on a weaker than normal footing. So retail sales are not strong. GDP is not strong. And one part of that whole article that is true is the labor market continues to be strong. Wages are still going up, but there's some indications that if the Fed is patient, they may see that strength ebb. One is that the labor participation rate is creeping up to pre-COVID levels, which means more people are coming off the sidelines and going back to work. Anecdotally, talking to a lot of people, actually, as we travel around the country, they're reporting to us that finding talent is a lot easier now than it was 6 months ago, which also suggests the labor market is loosening up. Seasonally adjusted employment gap, and this is a sign of strength. We're still running around 5 million people below where we should be based on pre-COVID employment trends. So we still have a need for people. And that tells me that once we're on the other side of a softness, slowdown, recession in the economy, employment's going to snap back pretty quickly, and wage rates are going to go back up pretty quickly. And what all this means for us is the bottom line. If you're experiencing a margin squeeze, it's likely going to continue because of the labor quotient. Commodity prices can be down all they want, but labor is what's driving the stickiness in inflation and doing damage to profitability. And whatever you can strategize or come up with tactically to protect that margin, reduce the labor quotient, make people more efficient, the better off you are going to be. Because the margin pressure vis-a-vis labor is only going to get more intense on the other side of 2024. That's it for this week's FedWatch. Thanks for joining us. Talk to you next time.